What a week we had. We had PPI coming in and showing us some signs of deflation. We had more banks on the brink of failure. And we had Treasury Secretary Janet Yellen coming in and confirming that the government only cares about large banks. We ended up starting the week at $381.81. We went all the way down to $380.65. Then we went to a high at $396.40, and we ended this week at $389.99. So how did we get here? This all really started on Tuesday, where CPI and core CPI came in at expectations for everything except for the month-over-month core CPI, which came in at positive 0.5% versus 0.4% expected. And this is actually increasing from the month before at 0.4% month-over-month core CPI. So this means that inflation is starting to pick up again in core, or excluding energy and food prices, which is showing us sticky signs of inflation, but the PPI, or the producer price index, told a completely different story. We saw the PPI coming in at negative 0.1% month over month versus positive 0.3% expected, so we ended up starting to see deflation in the PPI. But the question is, will the producers pass down these savings to the consumer or not? If the producers can get away with charging higher prices, then they probably will, and CPI will remain hot. We saw the retail sales, though, coming in negative 0.3% month over month, so there was less sales in February than what we saw in the unseasonably warm January, which ended up coming in at positive 3.2% growth month over month from December. So January was a really good month for retail sales, and then February ended up being a small pullback from that really good month. And then on Thursday, we had Janet Yellen testifying in front of Congress, and one of the Oklahoma representatives ended up exposing the government for what they truly are, which is a mob.
Will the deposits in every community bank in Oklahoma, regardless of their size, be fully insured now? Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVBP just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So what is your plan?
We made that determination.
Right. So what is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
That's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No,
fail.
it's happening because you're fully insured no matter what the amount is. If you're in a big bank, you're not fully insured if you're in a community bank.
Well, you're not fully insured.
So what they're trying to do here is they're trying to centralize all the money and all the power into large banks, and they're telling regional banks that they can kick rocks. The reason for this is pretty obvious: money, power, and political stance. So whoever is willing to give them the most amount of political donations, the large banks are going to come out on top. And then also on Thursday, you had the initial jobless claims coming in at 192,000 versus 205,000 expected. So there was less people that were unemployed this week than the week before at 212,000 jobless claims. And the continuing jobless claims ended up normalizing down to 1,684,000 versus 1,713,000 the week before. Finally, on Friday, the last piece of data that we got was the Michigan Economic Report, which showed that the inflation expectations for the next year actually ended up pulling back from 4.1% as of the last reading to 3.8%, and the consumer sentiment also pulled back with that down to 63.4 versus 67 at the last reading. So people are expecting inflation to slow down, but they're also expecting demand to slow down with that, which goes hand in hand. Right now, inflation is a demand problem where we have so much pent-up demand in our economy because of all the money that's flowing around that we created over the last few years. So as we destroy that demand by increasing interest rates, which increases the price of vehicles and mortgages and interest rates on credit cards, the demand is going to slow down, which ends up bringing prices down with that until supply and demand are in more of an equilibrium. So that's all the macro data that we got this week. And I was watching two earnings, which ended up being Adobe. Their earnings per share ended up coming in at $3.80 versus $3.68 expected. And the revenue ended up coming in at $4.66 billion versus $4.62 billion expected. And they ended up raising their guidance for fiscal year 2023 from $15.15 to $15.45 earnings per share, all the way up to $15.30 to $15.60 earnings per share. So this ended up being a triple beat where they beat on earnings, they beat on revenue, and they guided up. So their stock ended up going up by 9% this week. And then FedEx, the stock that I traded for earnings this week, ended up coming in at $3.41 earnings per share versus $2.67 expected. So a really big beat on their earnings per share. And the revenue came in slightly worse than expectations at $22.2 billion versus $22.76 billion expected. But they ended up increasing their guidance for the earnings per share from $12.50 to $13.50 earnings per share, all the way up to $13.80 to $14.40 earnings per share for the year of 2023. So this was a beat, miss, raise, and the stock ended up going up by 12% this week, which ended up netting me $100 of profit. If you want to follow the trades that I'm making, make sure to go check out my premium Discord linked in the pinned comment. But for the macro this week, what to look out for, we have on Monday the U.S. Federal Reserve's balance. This was supposed to be released last week, I believe on Thursday, but it ended up getting delayed. So it'll be interesting to see after all of these recent bank failures, what is going to come out of this and if it's going to get more spotlight than it usually does. And then on Tuesday, we don't really have anything going on, but Wednesday is going to be the big event on Wednesday the 22nd, where we're going to get the FOMC meeting, where Jerome Powell is scheduled to speak at 2:30, and they're going to give the interest rate decision for whether they're going to do 0, 25 basis points, or 50 basis points. Right now, there's a 62% chance that they're going to do a 25 basis points according to the Fed futures, and a 38% chance that they could pause as soon as this meeting. And by the end of the year, they're expected to cut 75 basis points from where they're at right now. But I think that the summary of economic projections is going to be a reality check. So the summary of economic projections is when the Fed gives out what they estimate the federal funds rate, inflation, and GDP to be by the end of the year. And right now, the markets expect 75 basis points worth of cuts. But at the last summary of economic projections, they said that they are going to continue to raise rates and they would be 5.25 to 5.5% by the end of the year. And I think that they're going to keep that guidance or even possibly go higher. And my reasoning for this is because Yellen made it very clear that the Fed does not care about regional banks. They only care about their political donors or the really large banks. So these regional banks, they can all kick rocks and they're going to go higher for their guidance for the federal funds rate by the end of the year. So that's Wednesday, the big event. And then on Thursday, we have the initial jobless claims, which is expected to come in at 199,000 versus 192,000 at the last reading, so slightly higher than it was last week. And the continuing jobless claims is expected to come in at 1,715,000 total jobless claims versus 1,684,000 last week. So they're expecting a decent tick up for the total number of unemployment. And then on Friday, we're getting the durable goods, which is expected to come in at positive 1.2% versus negative 4.5% last month. So the durable goods order is basically a proxy for the supply chain. So if there's more durable goods that are being ordered, that means that we're getting more supply in the economy. And if supply is able to keep up with the raging amount of demand that we have right now, then prices would come down. So if we see a positive reading, this will be disinflationary. And if we get above 1.2%, that would be really good for the market. And then the core durable goods is expected to come in at positive 0.2% versus 0.8% as of last month. And then the services PMI is also coming out on Friday, which is expected at 50.8 versus 50.6 at the last reading. So a slight uptick for services PMI, and this is the sentiment for the services industry. So if the services industry is expected to do well over the next year, then we would see inflation in services, which has been a real sticky point that we've had with services inflation coming in above 7% at the last CPI reading. So until we see services inflation starting to cool off, the Fed is going to have to keep at it with the higher interest rates. For earnings this week, we have Nike and we have Chewy. Nike is reporting on Tuesday, March 21st. The earnings per share is expected at 51 cents, and last quarter they did 85 cents. A year ago, they were doing 87-cent earnings per share. And historically, over the last 8 quarters or over the last 2 years, they've done 92-cent earnings per share. And then for revenue, they're expected to do $11.45 billion this quarter versus $13.32 billion last quarter and $10.9 billion a year ago. And historically, they've done $11.94 billion per quarter for the last 2 years. And then we have Chewy, which is reporting earnings on Wednesday after hours on March 22nd, where their earnings per share is expected to come in at negative 12 cents versus 1 cent a quarter ago and negative 15 cents a year ago. And historically, they've done $0.00 of earnings per share per quarter for the last 8 quarters. And then for revenue, they're expected to do $2.64 billion versus $2.53 billion last quarter and $2.39 billion a year ago. And historically, they've done on average $2.29 billion a quarter for the last 2 years. So this is going to be another reacceleration of their revenue if they're able to meet those revenue expectations. But if they're not able to, then their stock could end up selling off. But where would it sell off to? Let's check our technical analysis. For SPY, this is expected to be between $379 and $401 by the end of the week. So an $11 move in either direction, and we have supports at $386.58, $381.81, and then a Fibonacci level at $380. And then for resistance, we have $391, we have $395.25, and we have $399.03. And then for the trend line this week, we ended up closing above it for this week, but the line to look for next week on Friday is going to be $384.50. If we end up above that, that would be above the line. And if we end up below $384.50, that would be below the line for the end of the week. For Nike, this has an expected range of 109 to 131 by the end of the week. We have supports at 114.34, 111.38, and then we have resistance at 123.75 and 130.3. If we see a beat on earnings per share and a beat on revenue, I think this could easily go above $125. If we see a beat on earnings but a miss on revenue, I think this will stay above the 115 mark. If they miss on their earnings but beat on their revenue, I think this could maybe stay above $112. And finally, if they miss on their earnings and miss on their revenue, I think this could slip below $110 by the end of the week. And then for Chewy, the last stock on my watch list, the expected range for the stock is $34 to $44 by the end of the week. We have supports at $36.87 and $34.70, and then we have resistance at $40.73, as well as $44.51. If they end up beating their earnings per share and beating their revenue, I think this could go above $37. If they beat on earnings but miss on revenue, I think this could be above $35. If they miss on their earnings but beat on the revenue, I think this could stay above $34. And finally, if they miss on earnings, miss on revenue, then I think this could be slipping below $33. So that's my price analysis for the few stocks that I'm watching. Hopefully this video was helpful. If it was, show some love, leave a like. Thanks for making it all the way to the end of this video. And thank you to all my patrons, my channel members. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.